In today's video, we are going to talk about a married couple who is interested in whole life insurance. They are introduced to whole life insurance from a friend who successfully used his whole life insurance policy for real estate and other things. Their friend has a relatively large policy. He started with a large lump sum. It was 6 figures, max funded the policy, and he's been able to use it over the years. So in speaking with him, they became interested in whole life insurance and a little bit of information on them. So we've got their names, Joe and Sarah. These are not their real names. However, this case study is based on actual people. We just changed the names to protect the innocent. But we've got Joe and Sarah here. They own a small business. It's growing. They're opening up new locations. They're cash flowing. They're doing well in their business. And they've also invested in real estate over the years. They've got properties that they own free and clear. So they know what they're doing when it comes to real estate. They're looking at a whole life insurance policy as a potential product that can complement what they are doing right now. So in meeting with them, they had done a lot of research. They also have a friend who is informed about the product and knows how it should be set up, meaning they can show any policy or illustration to their friend and he can say, this looks good or this does not look good. And what I mean specifically is when you're paying $1 into a policy, how much of that dollar is in cash value in the first year? If the policy is maximized for cash value, we should see at a minimum 80% of our first year payment in first year cash value, and it can even be as high as 90%. So that's specifically what he's looking at, and then also we'll measure the long-term performance as well. But here's what they're interested in. They said, we want to present our situation to you, and then you tell us what to do. Show us a couple different products, but we want to know what is the best option when it comes to getting money into the policy and then using it for real estate. So some information here. We mentioned that they have a growing business, so they can cash flow the policy at about $100,000 per year. And that's something we discussed quite a bit. So before I get into the $100K per year, they've got cash on hand right now, $200,000 that they'd like to use up front. So they want to start the policy with a lump sum and then have the ability to fund $100,000 per year. Now, on this piece right here, I said ability to fund $100,000 per year. They stated that they do not want to bill for $100,000 per year. While this is a number they think they can hit, they do not want to be stressed out with the policy. They don't want it to feel like a burden and feel like they're on the hook that they have to pay this dollar amount every single year. Well, the good news is they don't have to do that. So the follow-up question here is, what's my minimum? And the answer to the question is, if we're going with the policy or combined policies where the maximum amount is $100,000 per year, we can set the minimum at about $10,000 per year. And this is something we discussed. We talked about a $50,000 maximum, a $75,000 maximum, and after discussion, they did agree that $100,000 is a number they're comfortable with. Why not start with 50K? The reason why is because their business is growing, and they looked at their situation and said, 50K per year, we think we'll definitely be able to do that, but we think we'd like to be able to pay more into the product as the years pass. So if we can commit to a small amount, call it $10,000 per year, hit 50K per year, we're confident we can do that, but even get up to 100 in some years, that's what we would like to do. And the reason why, because this is a whole life insurance policy, if you're new to whole life insurance, a question that might come up is, why would someone want to put $100,000 per year and $200K upfront into a life insurance policy? The reason why is because they're interested in the cash value benefit. The death benefit is important, but the cash value is what they're interested in. And when these policies are being funded, what we're doing is getting as much of that funding to the cash value component and then minimizing the insurance premium or the insurance expense. So what we've got here on the right, what do they want to use the policy for? Firstly, we've got the death benefit here. A concern they expressed is that they own a business, it's growing, the husband is vital to the business. If something happens to him, the company is in trouble. So as we looked at the numbers, you'll notice that Sarah is a little bit younger than Joe. She's 45. Joe's 52. Actually, I think he's 53. So not a huge age gap there, but if we were going to put money into a policy and just looked at everything going into one policy on her versus everything going into one policy on him, when the interest is cash value, what you'll notice, or what you would see, is that the performance will be a bit more favorable on Sarah. One, because she's younger, and two, because she's a female. What I mean when I say that is that females on average live about 7 years longer than males. And why that's important to be aware of is because if the insurance company knows that we'll live longer, the insurance expenses are a little bit less, which results in more money, more cash value, and long-term death benefit performance. So it won't be a huge difference, but we will see slightly stronger performance for her. So if the goal was strictly maximizing the cash value, we could put it all on her. However, in speaking with them, having life insurance is important. So they do want a policy on the husband. Also, from a legacy standpoint, legacy planning and generational wealth, that's something that the husband specifically brought up. So just in conversation, looking at the need for death benefit on the husband and them wanting to leave a legacy, and also looking at their growing business, we looked at splitting the policy between the two of them 50-50. And what I mean when I say 50-50 is if I'm starting with a lump sum of $200K, $100K up front, and then $50K per year thereafter. And when you have a case like this, what we like to look at is each policy standalone and then also the combined values. Now their priority here is again cash value and maximizing it. They expressed that. They said the death benefit, we are concerned about that, but what we don't want to do is sacrifice too much cash value performance. We still want to make sure that's maximized. And then use it for real estate investments. That's what they are very, very interested in doing. They're even interested in doing this in about 60 days after starting the policy, which doesn't always make sense, especially when you look at the negative hit on your policy in the first year and the fact that you're paying loan interest. But what I'll do at the end of this video is walk through exactly what we showed them and what I would show anyone in a case like this, so you can see firsthand, here's the first year hit on cash value, here's what you're paying in loan interest, so immediately it hurts you more than it helps. However, if you pay the loan back over time, here's what it looks like. Here's your cash value gain. Here's what you've paid in loan interest. This way I can see it. I can see exactly what the numbers show, and then I can make a decision if I'm comfortable or not. We found that that has helped a lot of people. So let's take a look here, shall we? Joe and Sarah, let's look at Joe's policy first. So what do we have here? On the left, in red, you've got minimum $5,000. That is your minimum premium. So what did we have on in red on the whiteboard? They do not want a bill for $100,000 per year. We're also splitting the policies in half. So this is one policy on Joe. The minimum is about $5,000 per year with the premium, term riders, and everything. It's actually a little bit higher than this, but very, very close to 5. First year, lump sum, $100K. Remember, this is just Joe's policy. First year cash value, 92%. That's a cash-rich policy right out of the gates. Death benefit, kind of an oddball number, $1.45 million. We solved for the minimum death benefit here to give him a MEC limit of $100K. MEC limit is our modified endowment contract limit, which prevents a taxable event. Core benefits to the cash value of a life insurance policy, safe, liquid, and tax-free. So as we look at Joe's, how's the performance? Break even between years 3 and 4. Very close in year 3, and this is due to this large lump sum up front. Okay, so that's Joe's policy. Let's look at Sarah's policy. Look familiar or similar? It's because it is. Same minimum, same 100K, same out-of-pocket over 10 years. Higher death benefit because she's younger. We do need more life insurance to get the same MEC limit. But again, same minimums, Break even is just about year 3. It's a strong upfront cash value. And then we stopped after year 10. They could go longer than this if they'd like. They could also stop earlier if they choose to do so. So we did build in a lot of flexibility there where they can adjust the funding amount and the funding period as time passes. So then what we'll look at are our combined values. So this is the exact same thing. It just makes it easier for them to see everything on one spreadsheet as opposed to looking at 2 side by side. So now I see that my total yearly minimum is 10K. First year, I plan on starting with 200K right out of the gates, and then 100K per year thereafter. Okay, fantastic. This is what I'm committed to. So what they can do with this policy, going back to the fact that they are not billed for $100,000 every year. They're billed for the 10. Everything else, the other 90, 1, it's optional. They do not have to add up to 100K per year. 2, it's at leisure. So these policies are with Guardian. What they can do is log into their online portal, use their mobile app. It could be a wire transfer or even mailing in a check. They can add additional funds to PUAs at their discretion. If they don't fund it, as the illustration shows, which is everything up front, the actual values will look different than what we have here. But the purpose of me mentioning that is just to discuss their flexibility. Then we've got these columns on the right. So what these are showing, cash value growth. This shows what the policy is growing by each year, and then cash value gain. First year is the worst year. When people ask what are the drawbacks to this product, to whole life insurance, my response is this: the worst year is the first year. No matter how well a policy is designed, I have this hit up front. So you pay in $200,000 in this example, you've got $184, that's a $15,000 hit. They actually selected a different product. They saw this product compared to 2 others, and they selected a product that gave them about $175,000 up front, which is a $25,000 hit. So different products will have more or less cash value up front. They selected an option that gave them less up front because they liked the long-term potential. And there wasn't much of a difference when they hit year 10. So they were comfortable with it after seeing the options. That's the big thing. But the first year is the worst year. I make a payment, I get less back than what I pay in. Okay, let's look at year 2. So at the end of year 1, we'll start here. Your cash value is $184,727. You pay in 100 in this example. That's what you fund the policy with. It was 184. You added 100. Now your cash value is 289,807. If you earned 0%, meaning it gained nothing, what would your cash value be after you add 100 grand? It'd be 284, but it's 289. So what that means is you got your full 100K back, which includes the premium payment that does begin to come back to cash value beginning year 2 with this product, and then another $5,000 on top of it. First year is the worst year. It gets better and better each year after that. The next year, do the same thing occur, paying 100, I get it back, plus another 7,400, and the growth is increasing each year. It's compounding. That's what's happening. Cash value is compounding, and I'm adding more to it. Get a total of $1.1 million in this particular example. Then the cash value gain, that's pretty simple. That just shows what my total payments are, my total outlay, compared to my total cash value, and how much more or less do I have in cash value than what I paid in. So the first 3 years were in the red. Here's the reason why. Look at year 3. You've paid in a total of $400,000. Your cash value is $397. That's why I'm in the red, that approximate $3,000. The next year, my total payments are now $500,000. I'm at $508,790. $8,790 is how much more I have in cash value than what I paid in. That's why the gain is that number. You look at year 10, I've got a $183,000 gain because I paid in 1.1. My cash value is 1.283. So the 183 is the total gain there. So The purpose of going through that slow and thorough is because when we look at using the policy via loans, we use these two columns, the cash value growth and cash value gain, and compare it directly to the loan interest. I'll show you exactly what we did here. So they're interested in using a policy loan relatively early of about $150,000, and they might take another $200,000 out in the next year or the following. So this is for real estate. Here we go. Policy values, cash value collateral loan. This is how we simulate loans here. And then a comparison, which is going to compare the policy growth versus the amount we pay in loan interest. So let's take a look here. LTV, 95% of cash value. This will show the maximum loan we can take on any given year. So if they want to take a $150,000 loan in year one, can they? The answer to the question is yes, you can do that. The loan interest rate with this product is fixed at 4.76%. That's if they pay the loan interest. If they don't pay the loan interest, it is fixed at 5%. So year one, before we even look at loans, what do we have here? I want to make sure this point is emphasized. Paid in 200, you've got 184. That's a hit of just about $15,000 when we look at the numbers. Now, you took 150, 4.76% interest is what? Well, we've got it over here, annual interest payment, $71.40. So you took this hit, $15,273, and you've got the annual cost to borrow, $7,100. You're over $20,000 there in insurance expenses and also loan interest going to the insurance company. So does it make sense to take a policy loan in the first year? When we just isolate year one, the answer is often no. Some people will look at it and say, okay, long term, I'm recapturing the money though. That's why I'm interested in this. Because what's true is that I continue to earn dividends and interest on my entire cash value, even though I've borrowed against it. So while I've got this 150 outstanding, it's still compounding. And over time, the argument is I should be able to make up for the interest I'm paying here, whether I pay it back quickly or pay it over a long period of time. So that is the argument. However, it's good to have numbers to actually tell us if that's the case or not. So let's do this. So we said 150 and then another $200,000 loan in year 2 or 3. Let's take 200. So by year 3, you've paid in $400,000. You still have less than what you paid in. Scrolling our eyes to the right. Here we go, yearly cash value growth. I can compare this each year to what I am paying in loan interest when I look at it. So in year 3, you paid in $74.31. How much did you pay in loan interest? $16.60. Also, I don't want to overlook this, the death benefit. What happened to that when you borrowed? Reduced dollar for dollar. It's what the death benefit was, the 3,365. This is the combined amount on both of them, minus the outstanding loan balance of $350,000, meaning if I die with a loan outstanding, that's the net amount that will be paid out. And this is meant, again, to illustrate how cash value collateral loans work, which is taking a line of credit against the policy with a bank. It's very similar to how direct policy loans work, but we would run the illustration in a case like this. Numbers would be slightly different, but this provides a nice quick overview of what things look like. So let's assume they pay interest only for a while. Why don't we do it through year 10, the end of the funding period, shall we? So what we're going to do is begin to repay the loan, do it at $50K per year, toward the principal, because we're still paying loan interest each year. There we go. $50K per year. And what happened? As you're making those principal payments, the balance is coming down. As the balance is coming down, what you're going to pay in loan interest is going to lessen each year. Remember that this is a fixed loan interest rate. If a fixed rate on a life insurance policy, it's fixed for the life of the contract. So it's fixed. Also, seeing gains on a yearly basis. So I can compare each year. What's the yearly growth compared to what I'm paying in loan interest? That is the purpose of these two columns. Then if I want to take it a step further, we'll highlight these two in yellow. The total gain compared to the total interest payments. In this specific scenario, between years 8 and 9. I'll add this, years 8 and 9, you're making no principal payments on that loan. All you're doing is paying the loan interest each year. So why the total gain catches up to the total loan interest you've paid? Because you're compounding on your cash value. The growth keeps on picking up. The loan interest, if we're paying it each year, we're not going to see the dollar amount increase because, again, it is a fixed rate. So that's how they plan on using the policy. What we would actually show in a case like this for someone who's very active in real estate is taking loans more frequently, paying them back more frequently. Perhaps we reduce the funding some years if they don't want to aggressively fund the policy, but they want to pay the loan back faster. Have conversations and then show what the numbers look like. And this is a workbook that we provide to people we work with too, so they can actually get a quick idea of what the numbers might look like before they exercise or proceed with a transaction. So I hope that this video was helpful. Let us know your thoughts. And if you have any questions, please feel free to leave them in the comments below. And as always, I hope this helps. Thanks so much. Hey guys, Steve here with IBC Global. Thank you so much for watching the video. If you're interested in a whole life insurance policy and you'd like to work with our company in setting it up, please visit our website, ibcglobalinc.com. We would love to work with you. If you have any questions, please leave them in the comments below. And as always, I hope this helps.